Welcome back to the Dividend Uncle, your go-to place for all things dividends and REITs. In today's video, we're tackling a hot topic that's been making waves in the financial markets, the recent announcement by the U.S. Federal Reserve. As many of you might have already heard, the Fed has indicated it's unlikely to cut interest rates before May 2024. This news has certainly ruffled some feathers, especially among investors who were banking on earlier rate cuts to boost their REIT investments. Understanding the context, market reactions and investor sentiments. Let's set the scene first. The end of 2023 saw a market rally fueled by anticipations of rate cuts in 2024, with the REIT prices index climbing almost 20% since October 2023. Fast forward to now, and the rally has hit a pause, following the Fed chair's announcement. For investors who've been positioning their portfolios towards benefiting from these expected cuts, this delay might seem like a cold splash of water. But what does all this really mean for investors, and what should you do? Let's unpack the situation and what it signifies for your dividends and REIT portfolios. Staying the course, why patience pays off. Here's the big question: should this delay cause us to rethink our strategies? My take is no. And here's why. In the grand scheme of things, we're in it for the long haul. A few months' delay in interest rate cuts doesn't drastically alter the fundamental reasons we invest in our dividend stocks and REITs. In fact, this period could be seen as an opportunity to strengthen our positions, to buy into the dividend stocks and REITs that we've had our eyes on, at a pace that suits us, preparing for when the rates eventually drop. Strategically selecting REITs, a focus on interest rate hedging. Now, for those of us taking a more cautious approach, considering the prospect of higher interest rates sticking around a bit longer, and the potential impact on REITs distributions, I think focusing on REITs that have taken steps to hedge against these fluctuations is wise. Specifically, we're talking about REITs with a significant portion of their loans on fixed rates. Let me introduce you to 5 such REITs that stand out for their prudent capital management and could be worth your attention. First up, we have Daah House Logistics Trust. This REIT takes the crown for conservative capital management, having hedged 100% of its debt to fixed-rate loans. Moreover, its debt is in JPY, and with Japan's long history of low interest rates, this positions Daah House Logistics Trust in a favorable spot. Its focus on logistics properties, a sector that's seen robust demand, especially in e-commerce growth, adds to its appeal. Next on our list is ARA Global. With 96.6% of its debt hedged to fixed rates, REIT Global presents a strong case for stability in uncertain times. Its portfolio, focused on office spaces in Europe, benefits from long-term leases and reputable tenants, offering a blend of yield and security that's hard to pass up. Cromwell European REIT is another standout, with 91% of its loans on fixed rates. Beyond its prudent financial management, Cromwell European REIT boasts a diverse portfolio across Europe, spanning office, light industrial, and logistics sectors. Its strong operational performance and a high yield of close to 12% make it an attractive option for income-seeking investors. Mapletree Pan Asia Commercial Trust makes the cut with 85% of its debt on fixed rates. As a predominantly Singapore-focused REIT, its crown jewel, Vivo City, stands as a testament to its operational excellence. The Trust's strategic mix of assets across the Pan-Asia region offers investors exposure to some of the most vibrant retail and office markets. Last but certainly not least, Mapletree Logistics Trust rounds off our list. With 83% of its debt on fixed rates, this REIT has demonstrated remarkable stability and growth, even in the face of rising interest rates. Its focus on logistics and warehousing, sectors with booming demand from online retail and global trade, has seen its distribution per unit, or DPU, steadily increase over time. The Dividend Uncle's parting words. So, what should you, as an investor, do in light of the Fed's recent stance? Panic selling or drastic portfolio overhauls might seem tempting, but they're rarely the answer. Instead, this period before the anticipated rate cut could be a golden opportunity for strategic acquisitions and portfolio optimization. Look for dividend stocks and REITs that have not only demonstrated financial prudence through interest rate hedging but also have strong fundamentals and growth prospects. Remember, investing, especially in REITs, is about taking a measured, long-term approach. Market fluctuations and policy changes are par for the course, but they don't have to derail your investment journey. Instead, they can provide opportunities to reassess, adjust, and even strengthen your investment strategy. Thank you for joining me today. If you found this discussion helpful, please like, share, and subscribe for more insights on navigating the world of REITs and dividend investing. Until next time, keep investing wisely, and let's look forward to building that wealth, one dividend at a time.